Learning objective 2 is the key to all accounting, so pay attention. It's the accounting equation, and it's really not that hard. I mean, it gets very complicated, but it's not very hard. It is the formula right here. Assets equals liabilities plus shareholders' equity. That's it. Wow, that's it. That's all there is to accounting. Well, not quite, but that shows you, and we'll start expanding it. So expanding it a little bit is the assets that you own are equal to the liabilities, which is your borrowings, plus the stock that you sold to investors when you're starting a company or as you're growing your company, plus the profits that you kept in the business. That's all there is, because you have assets, but how did you pay for it? You can only pay for it by borrowing money so you could use it, or by getting stock and using the investor's money for that, or earning a profit and keeping the profit in the company and using the profit to build the company, right? There's only three ways for you to buy the assets you have: borrowing, which is liabilities, stock sales, which is contributed capital, and retained earnings, profits you retained, profits you kept. So it's in the sentence below for those of you who aren't algebra people, they're more verbal people. Our assets are acquired by borrowing through liabilities, by shareholders' investments in us, which is stock sold, and the profits that we kept in the business, known as retained earnings. That's it. So that's the accounting equation, and we're going to be going into each of those components and drilling deeper and deeper into what those accounts are and how it ties into other aspects that lead to the four financial statements. So the four statements are balance sheets, and those are on the two ends, and those are assets equals liabilities and equity. The three in the middle are for the period. So think of it as beginning is a balance sheet, end is a balance sheet, and the three in the middle explain what happened during the year or the period that you're covering. So the first that is most easily understood is the income statement. Now, during the year, we ran the business. We had revenues, we paid expenses, we made profit, we hope. So that's the income statement. Obviously, a very important statement. The second is, what happened to shareholders' equity? Did we sell more stock? Did we pay dividends? What happened during the year to the stockholders' money? That's the second statement of stockholders' equity. And the third is a statement of cash flow. We'll learn that the fundamental approach to accounting uses a thing called accrual accounting. The statement of cash flows looks at the business from that very bare bones reality of cash, right? So these statements in the middle, right here, represent the explanations of what happened during the year, and the balance sheet at the beginning and the balance sheet at the end are like the end posts, and everything happens in between. At the end of the current year, we close the books and we go on to the next year, right? So the end of year balance sheet becomes the beginning of the year balance sheet for the next period, and then it just rolls over, and that's how accounting perpetuates. That the three in the middle, the income statement, shareholders' equity, and cash flows, are for a period of time, a quarter, a year. And then the balance sheets are like a snapshot. Think of it as like a camera, snap, a shot, a picture, right? Those are what balance sheets are. So the balance sheet is at one point in time, we mentioned that just earlier. It says, what are the assets, which are resources? So that's the first piece of what do we own? So that's this side, the first part. The second part is we have liabilities and equity. Liability in the book we'll call non-owner financing. Okay, they're lenders. And then the next are owner's money, which is stock that they bought plus the profit that has been kept in the company. And that's what the balance sheet is. Now, Under Armour is an example. You probably know this sporting apparel company. And Under Armour's balance sheet looks like this. We have assets equal to liabilities and equity, right? You'll always see these. So this total here, the $2.9 billion equals the total liabilities plus the total equity is the total, right? So these two must match on all balance sheets. So a balance sheet is straightforward. It's the accounting equation, but it's organized in a very specific way, and it's providing levels of detail, and you could just keep going and digging deeper and deeper to go further and further into accounts. But the idea is back all the way up to the simple idea: assets come from liabilities and equity. And so that's the balance sheet. All right, we have two different views here. One is looking at the asset side of the balance sheet, and the other is looking at the financing of the business, the right side view of the balance sheet. So the first example is a measure of the relative proportion of short-term and long-term assets, where the orange represents short-term and the green represents long-term assets. So the items with a lot of orange has a lot of short-term. The items with small amount of orange has not a lot of short-term. Then you say, well, I don't even know what a short-term asset is. So the difference between long-term and short-term is, think of 1 year. If the asset is cash now or will become cash in a year, it's short-term. So cash receivables, which are monies that your customers owe you, your customers better pay you in a year, so those are short-term. And inventory. Inventory is stuff you have to sell. You better sell it in a year. So those are examples of short-term assets: cash, receivables from customers, and inventory you want to sell. The orange are long-term, things that are more than a year in terms of it's sticking around. So what is that? It could be land, it could be a factory, it could be a warehouse. These are things that you have, necessary for many businesses, that are going to stick around for more than a year. That's long-term. So let's look at the different industries. So if we look at this section here, we see some companies, like on the far left, Cisco. Cisco is a company that's very profitable, and they sell networking systems. What you'll see is they have quite a bit of short-term assets and not a lot of long-term assets. We look on the other side, company like Comcast. Comcast is a cellular phone and cable TV company. So they have a lot of investments in wires and cellular towers, in gear. So it's a very capital intensive business because they have to have a lot of investments in hard assets to do their business. So their orange section is very small. Their orange section is cash. They don't have a lot of cash. And they have some receivables because people owe them money. But people pay their phone bills pretty quickly, or their cable TV bills pretty quickly. So their receivable is very small. And they have no inventory, right? They don't sell products. They sell a service. So this shows that there is no one right answer to what is a ratio for a company, because it depends on your industry. And so if you have a company that has a lot of capital, like a cellular phone company, you're going to have a very small percent of short-term assets. If you're in a business like Cisco or other service businesses, they're going to have a lot more short-term assets. On the right side, we have relative proportion of liabilities and equity. You recall that this is the right side of the balance sheet, and it's where did you get your money? Like who enabled you to buy these assets? So the orange here represents liabilities, and the green represents equity. So the ones with more orange have more debt. The ones with more green have more equity. So again, when we look at the industries vary, with Home Depot having a lot of debt and very little equity, whereas a company like Alphabet, better known as Google, has very little debt and a lot of equity. So again, there's no one right answer to what's the right amount of debt or equity for a company to have. It varies widely by industry. So this is just an example of how we use financial data that we see in a balance sheet. These are all balance sheet numbers, to tell us something about a business or something about an industry. So this is the use of data. So we're going to be bouncing around in this course with how does the number get there? How does it show up on a balance sheet or income statement or whatever statement? And then how can we interpret it to get to the answer of so what? Hopefully you get all the so whats.